the end of the webinar to the Q&A session. To ask a question, please hover over the bottom of your screen and you'll see a participant button appear. Click on the participant button, and then you'll be able to click on the raise hand button. Those with raised hands, we will announce your name and unmute your line for you to ask your question. We prefer that you use this method. However, you may also email your questions to ralfano@madisonpension.com. And that's RALFANO@madisonpension.com. Now I will turn it over to David.
Frank, thank you, and good morning, everyone. Today we will be reviewing the changes that have been made and will be made to retirement plans and IRAs as a result of the passage of the SECURE Act. I expect the webinar, my presentation, to last about 45 or 50 minutes, and then we will allow for about 10 minutes of questions. Please hold your questions until the end. So, next slide, please. By the way, I also want to thank John Hancock for providing the technology to do the webinar today. So, the setting every community up for retirement enhancement, government loves acronyms, and the F before they just ignored, was signed into law by President Trump on December 20th, 2019, as part of the Further Consolidated Appropriations Act of 2020. The SECURE Act is very comprehensive and contains many provisions affecting qualified plans and IRAs. We're going to go through most, but not all, of the provisions in this outline. As you will see as we go through the Act's provisions, a large part of the Act is intended to encourage the implementation of new retirement plans and to simplify certain current participant notice requirements. Plan design opportunities, what you can and cannot do, are pretty much as they were before, and in fact, in certain cases, they have been enhanced. At the bottom of each slide, where applicable, we have the effective date of the specific portion of the SECURE Act. Brian, next slide, please. So the first big change, which everyone is probably aware of in some way, shape, or form, is the change in the required minimum distribution beginning date. So previously, you had to take your first RMD on the April 1st following the year you attained 70 and a half. That has now been changed to the April 1st of the calendar year following the year you attain age 72. But remember, in both cases, if that April 1st date was never anything but an administrative delay, and if you do use that 4/1 date, you need to take 2 distributions in that first year. So who is subject to the old rules? Basically, any individual who attained 70 and a half in the first half of 2019 is still subject to the old age 70 and a half rules, even if you defer the first required minimum distribution to 4/1/2020. And who's subject to the new rules? Anybody who attained 70 and a half in the second half of 2019. In other words, you were born on or after 7/1/1949. So down below, you've got somebody who was born on June 30th of 49, turned 70 and a half in the first half of the year, so their required beginning date is 4/1/2020. Somebody born on 7/1 the next day, 49, their required beginning date is 4/1/2022. So this actually answers one of the questions that I raised in my invitation. If you turned 70 and a half in 2019, but elected to defer your first RMD until 4/1/2020, can you now wait until age 72 until you take your first RMD? The answer, as we now know, is no. Brian, next slide, please. A couple of other changes to that apply to IRAs. So required minimum distribution rules, basically, we're going to say goodbye to the stretch IRA. For spouse beneficiaries, the RMD rules really are unchanged. The option to roll over the remaining account balance to an IRA in the name of the spouse is still available, or the spouse can elect to receive the distributions over their life expectancy. For non-spouse beneficiaries, the rules are changed. The non-spouse beneficiary can no longer receive distributions over their life expectancy. So suppose the beneficiary is the deceased son who's age 40. Under the old rules, the son could have taken the distribution over the son's actuarial life expectancy, which would have been 43.6 years. That was the stretch IRA. Under the new law, the stretch IRA is eliminated. Distributions must be completed by the end of the 10th calendar year following the death of the account holder, of course, unless the beneficiary is the spouse. The entire account balance can be taken, but right now must be taken in the 10th year. Couple of exceptions to the 10-year rule. If the beneficiary obviously is the spouse, if the beneficiary is no more than 10 years younger than the account holder. So if the account holder left it to his brother or sister and they were 3 or 5 years younger, they could take it over their actuarial life. If you leave it to a minor child, the 10-year rule applies, but only after attaining the age of majority and if you're disabled or chronically ill. With respect to an IRA left to a minor child, it is my understanding that the RMD can be taken over the minor child's life expectancy, and then once the child reaches the age of majority, the account must be taken by the 10th year. Again, it's got to all come out in year 10 after reaching the age of majority. Interesting question. What is the age of majority? They don't make any reference to it in the Secure Act. Different states have different rules for the age of majority. Most states use 18. A couple of states, Alabama and Nebraska, use 19. In Mississippi, it's 21. Did they mean that you default to the age of majority of the state that the minor child is domiciled in? I don't know. They need to clarify it. What I recommend everyone do is go back and look at their beneficiary form, whether it's the IRA or in the retirement plan. You may want to make some changes now that the stretch IRA is not around anymore. Brian, next slide, please. So some changes to IRA contributions. Under the old law, you were prohibited from making a non-Roth IRA contribution, deductible or not deductible, for tax years after attaining age 70 and a half and later. The Secure Act repeals the old law. The non-Roth IRA contributions are now permissible after attaining age 70 and a half. However, the deductible IRA contributions made after attaining 70 and a half go to reduce the charitable distribution exclusion. So let's say an individual who's 70 and a half or older makes deductible IRA contributions of $7,000 in 2020 and another $7,000 in 2021, total of $14,000. In 2022, the same individual takes a $25,000 IRA distribution and donates it to a charitable institution. Only $11,000, 25 less 14, is eligible for the exclusion. So you're really going to need to keep track of these IRA contributions as you move through time, if you're older than 70 and a half. And one minor change, compensation for IRA contribution purposes for now includes taxable non-tuition fellowships and stipends. So graduate students can now make IRA contributions. Brian, next slide, please. This slide refers to what I said earlier, how our government is Congress is trying to encourage startup plans. So now for new plans, there's a startup tax credit, and it applies to the first 3 years of the new plan. And in general, it's for an employer with less than 100 employees, and the qualified, the qualified retirement plan has to have at least one non-highly compensated employee. And a non-highly compensated employee is not always who you think it is. So let's say you hired a highly paid person in November of 2019, and you're paying them $15,000 a month. So $15,000 a month means in November and December.
My fault. Sorry about that.
Okay. Means that they only earned $30,000 in 2019. Stepping into 2020, they're actually a non-highly compensated employee because they have to make less than $125,000 in the prior 12 months. So the qualified startup costs relate to establishing and administering the plan and any retirement-related education of employees about the plan. The tax credit is the lesser of A or B. So A is 50% of the qualified startup costs after year 1, and then 50% of the annual administrative fees up to $5,000 in years 2 and 3, or the greater of $500 and the lesser of $250 per NHCE or $5,000. It sounds complicated, but it's actually not really that complicated. So assume the plan is established on 1/1/2020 and will cover 10 non-highly compensated employees for each of the first 3 years. The qualified startup costs are listed below for each of the first 3 years. In 2020, the plan document, enrollment meetings, implementation, the first year's administration, let's say it comes in at $10,000. In 2021, the plan administration fees are $4,000, and then in 2022, $5,000. So in year 1, the tax credit is the lesser of $5,000 or $2,500, which is $250 per NHC times 10. That's $2,500. In 2021, it's the lesser of $2,000, which is half of the 4, or $2,500. So that's 2. In 2022, it's a tie, $2,500. I have a question, and I have the answer. So let's say in a calendar year, there are 20 NHCs eligible for the 401k plan, but they're not all deferring. Do you get to count all 20? And the answer is, based on my understanding of the Act, you do. Just like in the old rules, anyone who's eligible is deemed to be an active participant. So NHCs who are eligible, whether they're deferring or not, become eligible to use for the credit. Does that mean that when we start new plans, we should be more liberal about letting in NHCs? Maybe. One other thing, you don't get both the credit and you get to deduct the fees involved in running the plan. So in my year one example, $10,000 was the fee, but $2,500 of it was a credit. So you only get to deduct $7,500, 10 minus 2,500. In year two, the $4,000, the deduction is reduced to 2 because you're getting a credit of 2, and so on. Brian, next slide, please. So under the old law, this is really this is a pretty big deal. Under the old law, you could adopt a new plan, but you had to adopt it by the last day of the plan year, within which you wanted the plan to be effective. Since most entities are calendar year plans, there was always a rush at the end of the year to adopt the new plan by the last day of the plan year. As most of us know, the funding, setting up the account, all of that could happen after the end of the plan year. But if you had not adopted the plan prior to the last day of the year, you didn't have anything. Under the new law, and by the way, I think this is kind of a mixed blessing, new plans can now adopt as late as the date of the employer's tax return, including extensions. So let's say an employer wants to adopt a new qualified plan for its 2020 plan year, and the tax return is on extension to 10/15. Prior to the Secure Act, the new plan had to be adopted by 12/31/2020. Now, the Secure Act, the plan has to be adopted, can be adopted as late as 10/15/2021, which raises some questions which the IRS will need to kind of clarify. So you need to file an extension to get the extension from July 31st to October 15th. But you wouldn't have filed an extension because the plan didn't exist. Similarly, for a defined benefit plan or a cash balance plan that you set up in year one, minimum funding deadline is 8.5 months after the end of the plan year, 9/15/2021. But if you set up the plan on October 1st, does that mean the 10% excise tax to make your contribution after 9/15 will be waived? I have to assume it will, but we need clarifying regulations. Brian, next slide, please. So there's some changes to the Safe Harbor 401k rules. So there are 2 Safe Harbor types of 401k plans. What we call the Safe Harbor matching plan and what we call the Safe Harbor non-elective. So the Safe Harbor matching plan, the notice requirements have not changed. You've got to give a notice no later than 30 days before the beginning of the plan year to have the Safe Harbor apply to the following year. However, that same rule did apply to the non-elective Safe Harbor. The non-elective Safe Harbor basically said, if you agree to make a contribution equal to 3% of an employee's compensation and fully vested, that was also a Safe Harbor. That had the same 30-day rule as the matching. So now they've changed that. So if you adopt the 3% Safe Harbor non-elective no later than 30 days before the last day of the plan year, so theoretically you could do it on the last day of the plan year, you would owe 3% as a non-elective contribution. You can now adopt it no later than the last day of the following plan year, retroactive back to the prior plan year, and you would need now the 3% in that first year would now be 4%. This may be a more cost-effective remedy than using a QNEC, which I'm going to go into in a later slide, to correct a failed ADP test. So let's say that a client had a 401k plan and they stepped into the end of the year with really poor participation. The client would very much like to take advantage of the full deferral and maybe even make a profit sharing contribution. So now, if they are willing to put in 4% rather than 3% and adopt the non-elective safe harbor, they can now defer the full 19.5 or the $26,000 if you're older than age 50. Again, the non-elective goes from 3% to 4% for that first year. And you may even, depending on the allocation methodology in the actual plan document, you may even be able to get another approximately $26,000 to the client, to the owner of the business, depending on what the plan allocation methodology says. So this can be a pretty effective technique to save perhaps a failed ADP test from, refunds, or alternatively, it can be used to design maybe a better plan for the client. Brian, next slide, please. In-service distribution rules. So in a defined benefit or a cash balance plan, you can now lower. So an in-service distribution basically says you haven't separated from service, but you want to take a distribution from the plan. In a DB or a cash balance plan, you had to be at least age 62 to take an in-service distribution. That's now been bumped down to age 59 and a half. The plan must be amended on or before the last day of the plan year. There are also there's a new distributable event in defined contribution plans. So for qualified plans, for the birth of a child or adoption expenses, the participant can now have a distribution on a per participant basis. It would not be subject to the 10% pre-59.5 excise tax. It would not be eligible for a rollover. However, there's no voluntary tax withholding, so no 20% mandatory withholding. It's got to be within at least a 1 year period following the birth or adoption of the child. The child must be at least under 18, and the spouse's children are excluded. So if a divorced couple, if the spouse adopts the minor children of the spouse, those children wouldn't be eligible for the credit, for the distribution, and the maximum distribution is $5,000 per individual per child. So let's say John and Mary are married and they're each covered under the same or separate DC plans, it doesn't matter. Mary gives birth to triplets. John and Mary can each receive a distribution of up to $15,000 for a total of $30,000. Actually, Mary may not even need to take the distribution because upon finding out that they're having triplets, John may just jump off the roof and commit suicide. However, if that doesn't happen, then they each are allowed to take out as much as $5,000 apiece per child to cover either the adoption or the birth-related expenses. In the act, they say that distributions are permitted to be repaid to the plan, but they don't say how that's gonna happen. You picked it up as income. How do you now back it out as income? Don't know. We need clarifying regulations. Brian, next slide, please. This is a big deal. Late filed 5500s, late filed Form 8955 SSA. The old law says if you didn't file timely, the penalty was $25 per day, max $15,000. That's now been bumped to $250 per day, max $150,000. The 8955, which is an attachment to the 5500, was $1 per day with a max of 5. Now it's $10 a day, max $50,000. Penalties can still be waived for reasonable cause or can be lowered significantly under the Department of Labor's delinquent file of voluntary compliance program if eligible. The new penalties apply to forms required to be filed after 12/31/2019. So basically, again, in my invitation, I asked the question, what if you had late filed 5500s for the plan years 2016 through 2019? You just find out about it now. Are you subject to the new rules? And the answer clearly is no, because the forms were due to be filed. They related to years prior to 12/31/2019. The best way to fix a late file 5500 is to take advantage of the Department of Labor's delinquent file of voluntary compliance program. The operative word here, though, is the voluntary. If you realize you've not timely filed 5500s and you voluntarily comply, the DOL, there are some financial sanctions, but they're really pretty liberal. So that really is the best way to cure the late file 5500s. Theoretically, if you get a letter from the Department of Labor telling you they don't have a record of filing 5500s and you realize you are late, theoretically, now you're not voluntarily complying, so you may not be eligible for the DOL's delinquent filer program. The other thing is that the Department of Labor and the IRS were pretty liberal about accepting reasonable cause. You know, they accepted almost anything. I have to assume with these new harsher penalties, they're not going to be as forgiving about late file 5500s. So clearly the takeaway here is make sure they get filed on time. You do not want to be in a position of having these new onerous penalties hanging over your head. Brian, next slide, please. So a new term, long-time, part-time employees must be offered the opportunity to defer. This is brand new. And again, it's the Congress's attempt to extend 401k plans to more people. So a long-time, part-time LTPT employee is an employee with 3 consecutive 12-month periods. They have to be over 21, and they have to work at least 500 hours within a calendar year. Service prior to 1/1/21 can be excluded. So the earliest date we need to worry about this is 1/1/2024. And this is not, you must permit these employees to make deferrals, but they will be excluded for coverage testing, non-discrimination testing, top-heavy. However, they will get counted for that 100 participant count rule for Form 5500 audit purposes. So here's an example. John is over 21 and works at the same firm part-time following hours: 2020 600, 21 7, 2022 550. He doesn't need to come into the plan because the first year we need to worry about this is 2024. In 2024, he goes over 500 again, 2025, 26 again. So the first year John would enter the plan would be 1/1/2027. Most clients don't have employees where this applies. But there are sectors of the economy, restaurants, for example, where the same seasonal employees may return year after year. So for those, sectors of the economy, they are going to have to deal with this. And tracking this stuff can be a royal pain in the neck. There may be a silver lining here, though, in that we all know that correcting a failed ADP test, generally what you do is you give refunds to the HCEs until enough money has been disgorged where the test is passed. There's another cure, this thing called the QNEC, Qualified Non-Elective Contribution, where you give the employer gives a fully vested contribution to selective, non-highly compensated employees until you pass the test. In other words, this QNEC becomes basically a deferral. The IRS treats it as a deferral. You now may have some rather low-paid people where rather than giving the refunds, which most HCEs really don't like and almost see it as a failing on the part of the employer, there now may be a group of NHCEs to give the QNEC to, and you may be able to pass the ADP test without giving refunds. Brian, next slide, please. Lifetime income disclosures. All defined contribution plans, not tomorrow, but sometime out in the future, we'll get to that in a moment, now have to provide a lifetime income disclosure at least once in a 12-month period based on their current account balance. It's got to include single life and joint and survivor annuity options. The Department of Labor is going to provide model disclosures, including actuarial assumptions, and plan fiduciaries will have no liability for what they put on the statement if the Department of Labor assumptions are used and you use their standard notice. So software vendors and investment platform record keepers are going to have to enhance their systems. The effective date is 12 months after the Department of Labor issues interim final rules. I have no idea what an interim final rule is. It's an oxymoron with model disclosures. One note, though, it does apply to every defined contribution plan. So if you have a pooled profit sharing plan, at some point, you're going to have to really, the TPA firm doing the actuarial and administrative work is going to have to put on the participant statement what the participants' accounts will be worth in terms of a lifetime income. Brian, next slide, please. Under the Secure Act, these lifetime income distributions were not particularly portable. The Secure Act now will allow them to be rolled over to a similar investment, even if it is not an otherwise distributable event. So offering a lifetime income as an investment option and distribution option was never required, and the Secure Act has not changed that. Some plans may have offered the option, the lifetime income distribution option, and later decided to eliminate it. Or it offered the option and the participant terminated, and the new employer's plan does not contain the option. Very few plans do. If the option did exist and it was then eliminated, the plan must communicate that to the participant and give the participant 90 days to roll out the IRA prior to eliminating it. Also, if the plan did offer this lifetime investment option and the employee terminates, theoretically, he or she will now have the ability to roll it over. Does that mean IRA custodians must now accept these options as part of a rollover? I don't know. It's a good question. Brian, next slide. MEPs and PEPs, what are they? So a MEP stood for multiple employer plans, and a PEP, which never existed before, stands for pooled employer plans. MEPs existed prior to the Secure Act. A MEP enabled numerous unrelated employers to adopt a single qualified retirement plan. So one plan document, different provisions for each employer. One Form 5500 was filed, bundling all of the plan assets together. So theoretically, employers were able to take advantage of economies of scale. They were created to reduce startup costs and administrative expenses, and theoretically increase investment returns through lower expenses because the investment pool would be that much bigger. MEPs were a problem, though. The IRS required that adopting employers have some commonality. They had to be in the same industry, or they had to be in the same geographic area, have some common ownership, or they had to belong to the same PEO. And the next one was really the problem. They were subject to this thing called the one bad apple rule. So if one adopting employer failed to meet all the qualification requirements, they didn't police the plan properly, and they didn't let eligible employees in, that potentially could disqualify the entire MEP and every adopting retirement plan within the MEP, even though everybody else did nothing wrong. Brian, next slide, please. So the Secure Act created a new type of MEP called this Pooled Employer Plan, or a PEP, and administered by a pooled plan provider, a PPP. So theoretically, PEPs, unlike MEPs, will not be limited to employers that are within the same industry or geographical area, and it repeals the one bad apple rule. If there is one bad apple, it must either be restored to compliance or spun off from the plan. Spun off where? Don't know. PEPs are subject to audit requirements, but only if either the plan covers 1,000 participants or any of the adopting employers has more than 100 participants. This is not effective immediately. It's effective for plan years beginning on or after 1/1/21. And theoretically, the Department of Labor and the IRS will issue guidance regarding the operation of them. This is one of those things that sounds like it may save investment expenses and save administrative expenses, but I have some concerns. Basically, what sort of training and consulting support, what sort of training for the employees of the administering the PEP will be available? What kind of plan design opportunities and compliance questions will be answered? What level of confidence will plan sponsors and referral sources have in the answers they receive? What will the investment lineups look like? Who's going to police the investment lineup? Who's going to kick out a fund that's underperforming? Couple of other concerns. At some point, the assets accumulated in these PEPs are going to be very large. Hundreds of plans, maybe thousands of plans will be joining. Large plans with $700 million, $2 billion, are already a source of litigation because that's where the money is. The litigation firms are following the money. As these PEPs begin to accumulate a real critical mass of assets, will they become litigation targets? And going back to one of the bullets, it says if the PEP has one bad apple, they either have to, the client has to restore it to compliance, or they have to spin it off. Well, the PEP doesn't have any control over the client. So let's say the plan became top heavy for whatever reason, and the client never put in their 3% contribution, and the PEP goes to the client and says, you owe $30,000 to the NHCEs. Client says, I don't want to put in $30,000, and I'm not putting in $30,000. Says the PEP can now spin it off. How do they do that? If they don't do that, does that put every other client in the PEP at risk? So there are some questions that need to be answered before these things, I think, become real popular. Hopefully by 1/1/21, we'll have some more guidance on this. Brian, next slide, please. So 403B plan terminations and custodial accounts. So 403B plans are plans for not-for-profit organizations and educational institutions. The problem with 403B plans, they operate very much like 401k plans. They have a plan document. The document talks about eligibility, vesting, all of that stuff. If there's a match, that's got to be hardwired into the document. However, they differ from 401k plans in one really different way. The account, the deferral account for the participant is owned by the participant, not by the plan. So, and I've seen this, the 403B plan is not real popular. There haven't been a lot of participation. The organization is paying fees. They want to terminate the plan. They send out packages to the employees saying, we want you to roll your money out. And on their deferral account, they don't take any action. They don't do anything. Well, since the account was controlled by the participant rather than the plan sponsor, they didn't have any ability to make that money go away. The money can't go away. The plan couldn't be terminated. It was, so you've got a client with a plan they don't want anymore, and they can't make the plan go away. Ongoing administrative expenses, if the plan has to be restated because of a change in the law, they've got to do that. So now, theoretically, and again, I'm not sure how this is going to happen. If the not-for-profit or the educational organization wants to terminate the plan, they can treat these custodial accounts as if they've been rolled out to an IRA, even though they haven't been rolled out to an IRA because no action was taken. So now the plan can actually be terminated. So for any 403B plans that feel like they're stuck, so if any of you are on the boards of not-for-profits, and there's a 403B plan in there that you feel like you're stuck with it, there's now a path to actually make the plan go away. So, Brian, next slide, please. At some point, probably all plans are going to need, certainly defined contribution plans, probably not defined benefit plans, are going to need to be restated. So the amendment, the restatement probably, will have to occur for the plan year beginning in 2022. So that would be the 12/31/2022 calendar for calendar year plans. Union and governmental plans have another two years. While we're waiting for the plan to be restated, the plan would have to operate in accordance with the Secure Act. And if you've, so elimination of the 70.5 required minimum distribution rules, you have anti-cutback relief from that. So basically, we're kind of at the end of the presentation. Brian, next slide, please. If anyone wants to ask a question, now would be the time.
Yeah, thank you, David. We'll now move on to the Q&A session of the presentation. Brian, please announce your first attendee with a question.
So far, I'm not seeing anything. Do you want to describe how to raise their hand?
Yes, so on the bottom right, if you hover over your screen on the bottom right, you'll see participants. There's 52 of them. You'll click on the participant, and then you'll use the raised hand function. Or you can also do that on the right-hand side toolbar. There's a raised hand function to the right side as well. You know what, we did have some writing questions. We had some interest with plan sponsors regarding the Secure Act. One of the questions that came in, David, was as a plan sponsor, what should we be doing to make sure we comply with the Secure Act?
Well, happily, there really isn't a lot to do. The plans don't have to be amended until 2022. It's kind of administrative compliance, so it's almost the honor system. So there really isn't a lot plan sponsors need to run to do in terms of getting their plans into compliance.
Okay, there was another question. This is about the minimum distributions. With people living longer, will the minimum distribution life expectancy factors be increased, i.e. lowering the minimum distribution each year?
Supposedly, the IRS is going to issue new tables since people are living longer with longer mortality, so there will be a diminution, however small, of the required minimum distributions.
That's good news. One other question we had here, this is also regarding RMDs and as it pertains to Social Security benefits. So we know that the RMD age has been raised to 72. Do you know if the Social Security plans are raising the latest age to receive Social Security benefits from age 70 to 72?
I have not heard anything about that. And if that were to happen, I have a feeling the AARP would raise their ugly head and not be particularly happy. But I have not heard anything that Social Security is going to try to line up with the new later RMD rules.
Got it. I think we have another question here. So someone wrote in saying that they understand that the pre-tax IRA contributions can now be made when someone's age 70 and a half.
Yep.
Do they still have to have earned income to qualify for that?
Yeah, you can't have a deduction against no earned income. So yes, you do need earned income to make a deductible IRA contribution. That's true above 70 and a half and below 70.
Got it.
And Frank, we have a question from the line here. His name is Joe. So Joe, I went ahead and unmute your line. You can go ahead and ask.
Okay, quick question on the MEWAs. Basically, a multiple employer plan. All right. When will you see more guidance on how to establish them? And are you aware of any of the, per se, the TPAs that are willing to start to administer them?
I haven't really heard of any TPAs running to jump into these PEPs. Remember that the effective date for these are the plan year beginning on or after 1/1/2021, and the IRS and the DOL is supposed to issue guidance regarding how these things are going to work. They have been historically really slow. They get to give themselves an extension, which we don't always get in the private sector. So they've been really kind of, they haven't locked themselves in any time frame when they're going to issue that guidance. So I don't know, other than that they can't begin until 2021. I don't know of any firms that are running to jump into these.
I'm not disagreeing, right? But it is an opportunity for, you know, certain industries.
For sure. For sure.
Thank you for your question. Brian, do we have anyone else?
I don't see any more hands raised. If you want to, one more time, give instructions on how to raise your hand, I would suggest that.
Sure. Again, on the lower right-hand side, you'll see on the participant list, there's a mute me and a raised hand button, and you can click on the raised hand button, or you can hover over the bottom of the webinar and then click on the participant icon there, and then click on the raised hand feature there as well. Or you can email Rebecca Alfano at ralfano@madisonpension.com for any questions. I think we had one other writing question. I think there's a lot of buzz about the long-time part-time and the rule that these long-time part-times count as part of this 100 participant count.
Right.
And sponsors are concerned that now they have to do audits. Is there any way that this can be avoided with a plan design solution or anything like that?
Theoretically, there is a technique where if the long-time part-timers are going to take you over 100 participants, I mean, first of all, hopefully, the IRS may give a pass, but let's say they don't. If you take the long-time part-timers and you put them in their own plan, they don't, now each group gets counted separately for purposes of the 100 participant count, and you can avoid theoretically the audit. The bad news is you now have 2 plans to administer, but the cost of administering 2 plans is going to be less, almost for sure, than the cost of having an audit. So that's, you know, that solution is out there and it'll work.
Brian, do we have any other questions before we wrap it up?
Nope, that looks like it's it.
Well, thank you, David, for this informative presentation on the Secure Act Thank you, everyone, for listening and joining us today. It was a wonderful turnout, over 50 participants that attended. If you would like a copy of these slides, a copy of the recorded webinar, or have any other questions, please email Rebecca Alfano at ralfano@madisonpension.com. Everyone, enjoy the rest of your day.
Thank you.